Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
We are, no doubt about it, starting with the U.S. stock trade as a chorus of Wall Street strategists is warning about higher stock volatility. You got Morgan Stanley's Mike Wilson saying the latest to sound the alarm on economic growth worries. Other market forecasters include over at JP Morgan Chase, RBC Capital Markets, all tempering bullish calls for 2025. You know what's really the catalyst here? You've had Trump's tariffs really stoking fears of slowing economic growth, and you also had the president and the administration making some talks about the U.S. economy. Not such great ones over the weekend.
Well, let's get with it with Bloomberg Intelligence Chief Equity Strategist Gina Martin. She joins us here in the studio. Gina, the plunge in the S&P 500's most influential group, big tech. We got the S&P 500 going below its 200-day moving average for the first time since November of 2023. It's off at least, more than 8% from its high. The NASDAQ 100 off about 12% from its high. How much is tech weighing on the overall trade?
A lot. I think it's one of three monstrous issues weighing on stocks. It has been the case most of the year. If you look at the Mag 7, for example, they peaked all the way back in December. They're down 16% as of yesterday from their peak. So almost a bear market. Weakness. Yeah, pretty significant decline in the Mag 7. Of course, a lot of that is selected stocks, Tesla and NVIDIA weighing heavily there. But nonetheless, that in and of itself is creating a big drag on the index. But it's more than that. Clearly, the Doge firings and the concern about the ultimate consumer outlook as a result of that have been weighing on consumer stocks. At the same time, you do have the tariff chatter, which is creating sort of stalled activity with a lack of a better descriptive term, and a lot of uncertainty. And a lot of that tariff chatter impacts tech as well. I think this is a little bit underappreciated. If you look at the companies in the S&P 500 with their greatest cost of goods sold exposure to overseas economies, it's tech and communication stocks. So those groups being the biggest market cap share also really drove so much of the optimism over the last 2 years, and that's now unwinding.
So it's not a case of just repricing, because we've talked about, right, what a tremendous run-up we've seen over the last couple of years. So at some point, you got to expect some of that to come out of the markets. Is it still just a repricing, or we've gone beyond that?
Yeah, I think up until this weekend, it really was about a reset of expectations that were far too robust. I mean, this is something we started talking about in December. Our fair value models were detecting that inside the market, the S&P 500 was priced for greater than 20% earnings growth to emerge this year, which is a next to impossible task. This just doesn't happen unless you're bouncing out of recession.
Right.
So it seemed almost impossible for the market to satisfy those for the companies to satisfy those expectations embedded in market prices. There was also, though, this underlying narrative, if you will, in the market that the president was inordinately going to pay attention to the market as a guidepost, and he obliterated that theme over the weekend. I think he just crushed it.
You think so?
And that's what's happening today. Is he just said, we are going to have short-term pain for long-term gain. I don't actually pay that much attention to the equity market. He completely just blasted that whole theme out of the water.
We got clues. Well, I'm trying to think, was it the press event on Friday?
We got clues last week, but he said, I'm not paying attention to it. But then he also said a few minutes later, it's the globalists who are causing this sell-off. So that indicated to me that he was sort of paying attention to it.
Well, the globalists are causing the sell-off because the globalists recognize that tariffs are coming.
Yeah.
Right? Tariffs are coming. And even though he is saying they may or may not come, I'm using these as a negotiating tool, incrementally we have had more and more tariffs implemented so far this year. Maybe not as much as he originally said, but we have had more.
Do you buy it that he's not paying attention to the market? I know you said that idea got obliterated over the weekend, but look what happened during his first term. I mean, there were tweets, there were social media posts. Every time there was a new record. He did the same thing in the Biden administration.
I think we've rewritten history of what happened in his first term. If you look back at 2018, it was one of the most volatile years on record. We had Volmageddon the first part of that year. We had a 20% correction in stocks in the second half of that year. He didn't jump into the equity market to save the day by reversing tariffs in the second half of 2018. There's only so much that he pays attention to the market, but we've rewritten that narrative somehow in our minds. Now, yes, in the first year of Trump's term, we had magnificent returns to equities because he put forward tax reform. which is a net beneficial, has a net beneficial impact to earnings growth. And then we didn't get to tariffs until 2018. It's the reverse today. Tariffs have a net downside to economic and earnings growth that is inescapable. He recognizes this in his commentary. We hope that we might get to some kind of tax reform and some kind of domestic programs to substitute for the loss of earnings momentum from tariffs and some of the geopolitical risks that have emerged as well. But it's a hope, and hope is not a strategy. So the market is saying, okay, real time, things are a lot worse than we were hoping for.
If it is the strategy and it comes to fruition, so tariffs first, then tax cuts later, is that enough to juice the markets and have them come back and provide a floor? Or?
It could be. It could be. It depends upon what kind of tax reform we get. Our best guess is, based upon the promises in the campaign, we will get about half as much a benefit as we did in 2017. Just doing the math on the numbers. But it depends on how far earnings expectations have been suppressed with respect to tariffs and what comes out of those negotiations in the second half of this year. It's still very much up in the air.
So it raises the question about valuations, Gina, which Carol was alluding to a little earlier. The idea that people have said, by many measures, stocks are expensive right now.
Yeah.
They're out of line with historical standards from a PE perspective. Are we starting to see them come back to earth?
That's a great question. It's something we actually wrote about today for tomorrow, and the answer is no. Unfortunately, the reality of the U.S. equity market is we were so far above our valuation bogeys that even with the 7% or so correction that we've had in stocks so far, we're still near all-time high valuation levels set in the post-pandemic period. That's only for U.S. stocks, though, and it's really specifically for large cap stocks. I still think that the international opportunity is there, even with the re-rating. This is a year where international stocks are just likely to shine with the programs that are being initiated. And small caps have derated again. Small caps have had an absolute horrible February and early March so far, and they have derated once again to be at discounted levels.
Is there anything, just kind of final question, final thought at this point, anything about the selling that we're seeing that makes you a little bit nervous? I mean, the VIX is 28. It's not like it's up to 40.
Yeah, that actually makes me nervous.
Okay.
The fact that the VIX has, we talked about this a lot on our team call actually this morning, is what's happening here with volatility, because low volatility stocks are absolutely pummeling high volatility stocks right now. But the VIX has only incrementally moved higher. You love a huge spike in the VIX because those are usually affiliated with bottoming formations in the equity market, like we had with the Japanese yen meltdown last summer. We had a VIX spike all the way to near 40. I think it even got above 40 intraday. Very clear sign of panic. We don't have any panic emerging yet. Instead, we just have this sort of seesawing upward direction of volatility. The last pattern like that we saw was 2022, which was obviously a horrible year for stocks.
Right.
That was also the last time we saw such an extreme underperformance by U.S. equities compared to the rest of the world.
That was that when that yen blow up happened, Carol. That was back in August. The S&P 500 was at about 5,200. It's at 5,600 now, so about another 8% to go to get back to there.
Happy Monday, everybody.
Good news all around.
Gina, thanks so much. Gina Martin Adams, Bloomberg Intelligence Chief Equity Strategist.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're going to stay with the markets, but also broaden out and get a C-suite view. I mean, we've talked so much this year often about how European markets are outperforming the U.S. market by a wide margin. The Euro Stoxx 50 is up about 10% year to date, while the S&P is now down, I think, close to 5% in 2025.
With a view on that contrast and the continued electrification of our world, let's head on over to London and to Gwenaelle Huet, Executive Vice President of Europe Operations over at Schneider Electric. It's based in France. Schneider manufactures electrical power products. The company's ADRs trade in the U.S. this year down roughly about 5%. Gwenaelle, welcome. First up, the global market environment today, geopolitics. How difficult is it to do business in this economy, in this market?
Well, I think that what we are looking for is some strong position in Europe in order to shape what will be the future of the industry in Europe. And in that sense, it can be as an electroshock, right? To switch gears. I mean, for the past years, the European Union has been regulating quite a bit. Now we need to project that into concrete investments, into a very friendly environment for industry. And that's what we're expecting right now, right?
You are expecting a friendly environment for industry?
Exactly. I mean, the European Commission just announced a week ago a clean industrial deal in order to promote and accelerate the development of the industry in Europe. That's what we need. We need a European industry that is much stronger. We need to build and to boost its manufacturing footprint within Europe. We need to compete globally. And the European Commission has a role to play in that sense. Of course, we have a very strong assets. The first one is being a very large internal market, but at the same time, we have very strong industrial players. So we need to leverage on that. And the problem is that in the past years, there were a lot of regulation, sometimes over-regulation. And now we need to come around more incentives, how to accelerate through more incentives, friendly environment, instead of only compliance and just regulating in a very difficult way.
Gwenaelle, I do want to ask you, though, about the U.S. market versus the rest of the world. I mean, how do you describe the demand that you're seeing from your U.S. customers? And from what I understand, you guys produce about 83% of what you sell in North America locally. But tell us about North American demand, U.S. demand specifically, and then what you are seeing in terms of demand outside the United States. Is it strong in both areas? How would you describe it for each?
Well, so just to put it simple, our model for Schneider Electric is a very much local model. So what we sell in the US is produced in the US, what we sell in Europe is produced in Europe, etc., etc. That's really very much important, especially in geopolitical context that you're seeing today. The mega trends that are below that, that are below the business, is around energy transition. It's around data centers and electrification, digitalization, and all that remains across the world. So I can tell you today that yes, we have huge demand in the US and we are building factories, expanding, etc. But Europe is also an area of growth. Why? Because we had in the past years the EU Green Deal favoring renewable energy development, favoring also energy efficiency, and this is taking off. So when you look at our numbers, yes, we created growth also in Europe. So that's why, we have to remain hopeful, because the sustainability asset that we have built across Europe is still valid.
What about in the U.S. when it comes to the switch to renewables? Because we've heard from the president that he does not favor the policies of the last administration. He likes to call the Green New Deal the Green New Scam. And he talks about drilling here in the U.S., not the switch to renewables. How does that affect your business?
But let me come back to Europe, because at the end of the day, this is an asset that we have built in Europe. So how to continue differentiated by developing the own technology in Europe. And there is a lot to be done. Look at electrification. Electrification in Europe is stagnant. So we need to accelerate. I don't want to give the impression that everything is done in Europe. On the contrary, we have to fight for more electrification, because again, this is a challenge, more digitalization, more renewable, and hence more investment into the network. This is not a done deal. So that's why when it comes to Europe, you have big numbers, big targets in terms of decarbonization, in terms of renewable energy, in terms of energy efficiency. We need to turn that into reality already in Europe.
But in the US, if you don't see those policies coming from the federal government, do you start to see companies moving away from that, and that affects your business?
Well, again, I told you, we are very much across the world, and in US, we are very much local for local. We have our own customers. We have a huge trend over there. And the mega trends that I was discussing about around digitalization, electrification is still happening. So let's not oppose one to each other. I think that we have to look at each and every market, and within these mega trends, which one can accelerate faster depending on the context that we foster. And in Europe, again, it's not a done deal. So that's why it's not against Europe, against the US. On the contrary, each and every region has their own pathway. The question is that now with the geopolitics, everybody is looking around. I think that we need to focus on the own market, and being the most local company is really an asset.
So it sounds like, and forgive us, I think we're just, came in Monday and we saw a global sell-off, and I think we're trying to you have a great vantage point in terms of looking around the world and in terms of business and really trying to understand. I mean, you guys sell big time. North America is your biggest market. Asia Pacific is just right behind it. Western Europe, of course, as you've been saying, very, very important. And then, you've got almost $5 billion in the rest of the world. So you really have this great snapshot of what is going on globally. And I think we're trying to assess, as we watch the U.S. market come down, we saw European markets also under pressure, that are we starting to see some kind of global slowdown? It sounds like from what you are saying that you're not worried about it, whether it's a U.S. recession or global recession. That's not necessarily something that's in the cards from what you are seeing. Is that fair?
You know what? Why I'm so optimistic is that I'm looking at the mega trends that we at Schneider are positioned. Okay, It's climate change, it's energy transition, it's electrification, it's digitalization. Those mega trends are not slowing down, so that's why we are still optimistic. And to give you one example, you're saying it's challenged in Europe. Today, there is a discrepancy between commitments that leaders have been taken and the reality of the projects that are developing. So we need to accelerate. So that's why I really want to continue pushing and showcasing that even in a country or in a region that is so committed to the energy transition, we need to continue having attention. I give you one number. Just, to fulfill the commitment that we have in Europe for renewable energy, we should develop 30 gigawatts of wind a year. And now we are developing only 17 gigawatts. So it's just to showcase you that in reality, the acceleration should be made also in Europe.
Good stuff, and some perspective on a day where it's very easy to get distracted, probably rightfully so by the markets and concerns about the outlook, but certainly some optimism from Gwenaelle Huet. She's Executive Vice President of Europe Operations at Schneider Electric, joining us from London on this Monday.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, we heard a lot about the equity market just now from Charlie. I want to talk bonds because bond traders are signaling an increased risk that the U.S. economy will stall as President Donald Trump's chaotic tariff rollouts and federal workforce cuts threaten to further restrain the pace of growth. We've got with us Michael Mackenzie. He's Bloomberg News rates reporter. He joins us here in the Bloomberg Interactive Brokers studio. Michael, as you write, there was speculation that the president would pour stimulus on an expansion. It would keep upward pressure on treasury yields. That is not at all what's happening. What's happening instead?
Well, I think investors have had to tear up the rule book. They came into this year thinking, okay, this economy is going to get pumped up a lot by deregulation, and that the Trump administration was going to be pro-business, and that's not really how it's panned out. And I think some of the data's come on the disappointing side, and you're beginning to get a sense here that the cuts in government spending, if you think back to last year, we had a big tailwind from government spending under the Biden administration. So even when the market started pricing in rate cuts last summer and the Fed duly delivered in September with a 50 basis point rate cut, lo and behold, the economy held up. And by the end of the year, the Fed was saying, we're pretty much done. So the market's now having to get its head around the risk, or trying to price in the risk of, okay, if growth's going to slow, how much is it going to slow? And from discussions with a number of traders in the last week or so, it seems to be, if the data continues to point to a deterioration, then the Fed's probably going to have to start resuming rate cuts at some point, and probably gets the funds rate down about 3.5. And right now, that's where the market's pricing in, at least 3 rate cuts this year, which will get you down to 3.5. So that's kind of where we are at the moment.
Does the bond market equally reflect the nervousness that we're seeing in the stock market? I think we were talking with Mike McKee earlier, and he talked about spreads are still pretty narrow on different segments of the bond market. So does what we're seeing right now in the Treasury trade equate with the selling we're seeing in the stock market?
The other fact that's behind the rally we've seen in Treasury, so think back to in mid-January, we peaked at 480 on the 10-year, 460 on the 5-year. 10 years now back down to 420, and the 5 years is below 4% now. These are big rallies, and essentially that's reflecting the hit to risk assets. So when I was talking to investors at the beginning of this year, they were saying the one case for buying treasuries with the new administration coming in is going to be that if you get a hit to risk assets, you want to own the 5 to 10 year sector. That's really paid off, and that can continue to pay off if we continue to see more pressure on risk assets.
But are you saying then the moves that we've seen in yields already this year, the backing off, it's all of this nervousness already factored in, Michael? Or
to some extent, but I think you need another catalyst here. I mean, there's a lot more volatility in treasuries. The treasury volatility remains much higher than equity volatility.
Okay.
And that's just the constant having to sort of go back and forth with positions. We've been swinging around a lot in tight ranges to some extent, but the market is volatile, and there is some deterioration in liquidity at the margin.
The 10-year 4.2% is the yield that we're seeing right now. Carol and I were talking about this earlier as we were preparing for this afternoon. Isn't this what Trump wants to see? He wants to see the 10-year yield fall?
It does, and I think what's interesting is talking to some bond investors lately saying this is an administration that they think wants short-term pain, longer-term gain. Seems to be an administration that says, look, we're going to make some cuts to government spending. You're going to have a bit of turmoil, a bit of sort of turbulence, but they are hoping that this will get the economy back on track. And one key part of that is you keep rates down. So Scott Bessent has come out and said, I want lower 10-year yields. He doesn't want to specify to what level, but if you keep 10-year yields down, you are going to see more mortgage refinancings. And I think one thing that anyone who thinks that we're going into recession needs to ask the question, do you see balance sheet stress at the consumer and corporate level? If you don't, it's hard to make a case for recession. More importantly, though, look at the value of house prices today. You can now extract home equity from your house. So that will help buttress any kind of weakness we get in the economy. So I think the general tone of the bond market is the risks are rising, but we're not quite yet there to say, okay, this is a recession coming. That said, the real question here is the Fed going to actually look past potential inflationary consequences of tariffs and really look at a slowdown? And that's why the next couple of monthly payroll reports coming out are going to be very important for this market.
Is it just kind of interesting, though, Michael, that we went from earlier in the year, just nonstop American exceptionalism to all of a sudden we are using the recession word pretty regularly? Or
it's been bandied around. In general, talking to investors, they don't see a recession imminent. They don't really see this. And more importantly, though, think back to what happened last year. We had a big rally. So the 10-year last year got after September and the rate hikes, just before the Fed started, the 10-year fell all the way down to 380. But then it started rising again because, lo and behold, if you drop interest rates, it helps the economy.
Right.
Now, the question here is how much of a hit is this administration going to do with government spending? Bearing in mind, of course, that we still have Congress to decide on one big, beautiful bill. And lo and behold, if you're going to have tax cuts coming at the end of it, I would suspect the bond market could whip around again.
Seriously, that would be enough to make up all the tariffs and possibly more tariffs to come?
If you combine that with deregulation, if you now allow banks to buy more treasuries, if you cut all the red tape around small businesses, I think you could lay the case for a second half recovery. And then, of course, you have the problems of what is the ultimate inflationary impact of these tariffs that are coming through. I mean, I think right now it's a trade war that's really hurting sentiment. You're certainly seeing that on equities.
Yeah.
The Fed set to meet next week. What is the outlook and what's happening in the bond market signal about expectations for the Fed for this year?
Well, if we look at the March meeting, no one's expecting any move. I think the key here is May. We've been sort of dancing around pricing in about a 50% odds for a rate cut by May. So it's in coin toss territory. And I think you're going to have to see more. Obviously, you get inflation this week. Then you'll have another couple of months of payrolls and inflation to come before that May meeting. And that's, I think, will be the ultimate arbiter whether or not the Fed can go or not.
And if inflation comes in hot, that's not great news.
I think that puts the Fed in a really tough spot. I mean, I think at the moment they're okay, but they want to see inflation still trending down. They still want to see signs of disinflation. And if they get a hot number, that's going to complicate things, particularly if we see what happened in last Friday's payrolls report. We did see U6 unemployment pick up. Mm-hmm. If that continues, then you're going to hear more chatter about stagflationary outcomes.
What are you watching regularly? Like, what's top of mind for you as we kind of go through this?
It's every tape bomb that comes out of Washington.
Yeah.
And from Donald Trump, I think that's because he keeps flipping around.
Right.
So
Here.
everyone's got this kind of, what are they really going to do? And it's that uncertainty that I think is driving people to say, you know what, I'm going to put my money in the 5-year Treasury. I think the 5-year Treasury will tell you it's below 4% today.
Right.
Couldn't get below 4% at the end of last week, but is now below 4%. So that's telling you that there's a bit of concern. There's a flight to quality trade going on. And I think that's the one thing to keep watching.
I thought he was going to say like White Lotus 3 or like Severance when you asked what he's watching.
I'm a big fan of Parker Posey, by the way.
She's great in that.
I loved her stuff back in the 90s with Hal.
You got to read I think, New York Times profile on her a couple weeks ago. Just like
White Lotus 3.
She's awesome, yeah.
You mean anything to step away from this?
Yeah. What are you watching? Anything I can right now.
Michael Mackenzie, love. Bloomberg News rates reporter joining us here in studio.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, we've got just about 18 minutes to go until we wrap up this trade on this Monday. Having said that, you just heard from Charlie and Bill Maloney. We are definitely off our worst levels of this session, kind of bouncing around here, but still down 2.7% on the S&P 500. Dow Jones Industrial Average, a decline of just shy of 200 points. We were down more than 1,000 points on the Dow at one point, now a decline of 865 points. And the NASDAQ 100, which is dominated by that tech trade, it is down 3.9%, down 790 points.
Hey, curious what Max Wasserman thinks on a day like today. He's founder and senior portfolio manager of Miramar Capital. Max, you argue that the market is finally starting to recognize the risk of overvalued NASDAQ and the S&P 500 given the current market conditions. Is it still overvalued to you?
Well, thank you for having me on. And the answer is yes. I mean, the only thing that's surprising us is that we've been saying this for the past 6 months, that it took so long. But, the momentum has a funny way of turning on you when everybody can justify, earnings going up in multiples of 31, 35 times on these large cap tech. When the market sours, it can take them right back down. So we think they're starting to recognize that the multiples are still too high on the NASDAQ. But we think the general market is not priced like that, and there's a lot of opportunity there. But given the fact that the NASDAQ 100 and the top S&P 500 stocks is pure NASDAQ, basically, this is why you're getting this major sell-off.
How were you prepared for today's sell-off? How were you invested ahead of this if you thought that, if this isn't surprising to you?
Well, we have been lowering our tech exposure for a while. I mean, we have investments. We're a dividend growth shop. We have investments in the Broadcoms, the Apples, and the Microsofts, but we were underweighted technology. We've been putting more money into staples, which nobody wanted them, energy we like, and healthcare. You couldn't give healthcare stocks away. I mean, one of our largest holdings, like an AbbVie, is making 52-week highs. We just tend to think there was better value. We still like the growth in tech, but we're not willing to pay 30 to 40 times earnings for this.
So is this just a valuation reset? Is this just a potentially somewhat fundamental reset based on Washington policies? Or is this the U.S. economy starting to come undone?
I don't know if it's coming undone, or maybe we're just taking a better look at the U.S. economy. I think we're starting to say that the economy is showing signs of slowing down. And you have policies out there that are basically saying that they could hurt the economy. And if you go back to the fact that in December that the Fed told you that they're not going to be cutting interest rates, which Wall Street, desperately always wants, and because they had stubborn inflation. So there's a lot of things that are stopping that ignition of a further multiple expansion. I just don't think you're going to get multiple expansion. I think you're going to get a little bit of contraction, as it's showing, and the market's going to come back down to an equilibrium on where the fundamentals eventually show. But I think it's going to take another quarter or two for us to understand what are the tariffs, what is the unemployment really going to look like, what is the Fed really going to do. In the meantime, an uncertainty, who wants to pay 30, 40 times for these tech earnings right now?
Max, do you buy it that the president is not paying attention to the market, or rather maybe a different way to describe his comments over the weekend, saying that there would be short-term pain?
It's very hard for me to get ahead of any politician.
People keep telling me that when I ask these questions.
Yeah, but when you look long-term, there seems to be some inherent contradictions. But he did say that there could be some short-term pain. And his policies don't seem to be quarter by quarter. And for a president always just say he looks at the stock market, he's telling you he's not looking so closely. To me, it's the Fed. The Fed is telling you they're confused. They sort of want to cut interest rates, but there's stubborn inflation, and they don't know what inflation is going to look like with tariffs, if there's real tariffs, and how long they last. Because we don't know what the tariff looks like because it's on again, off again. And we don't know if April 2nd is really going to be reciprocal, what's going to be excluded. But it's very hard to run monetary policy with all those uncertainties. And when the Wall Street wants Fed cuts, and they're not giving it to them just yet, I think more pressure is going to be put on the Fed to eventually start cutting interest rates.
Are you more of a buyer or seller in this environment?
Well, it depends. Right now, a lot of our stocks, to be candid with you, are running very strong. So our top positions are hitting some 52-week highs. So we're waiting here. I am looking through the tech rubble once we start to get a little bit more of a sell-off to just nibble here and there at good companies that are paying us dividends that we like. We still like some of the large cap tech. We just think they need to come down more. And we're starting to see it. I mean, we like the Googles of the world. We like the Broadcoms, and we like the Microsofts. But, it's sort of, are we catching a falling knife? But, for nibbling purposes, yes, we would start because you're never going to time it perfectly. But when you have these great companies selling off 20% and still trading in the high 20s, low 30s, you could get another 10% here on the NASDAQ sell-off. But the equal weighted part of the market is showing strong signs. Look at the staples. Look at healthcare. Right. Look at financials that are taking a hit today. There could be some compelling valuations coming there.
I will note that there are 124 stocks in the U.S. right now, Carol, that are hitting 52-week highs. IBM, one of them. Another one is Tootsie Roll. Just thought that would be fun.
You gotta like chocolate, right? And we like Hershey, so it's the same thing.
Yeah, I mean, I'm looking at the S&P 500 equal weighted index, just down about 1.4%, so not as bad as what we're seeing in the S&P 500 at this hour. What about on the fixed income side of things? Are you anticipating that yields along the U.S. Treasury curve continue to go lower?
Well, that's a quandary. We've been telling people for the last 6 months, just focus on the short term, 1 to 3 years. We just don't think you're paid because we still think inflation's stubborn and we don't know. Do we think the 10-year could come down to 4? Yes, but I think it could equally go up to 4.85, depending on what the policies play out. So we just don't think you're being rewarded to go long term. We would still say stay short term, stay high quality. We still like U.S. Treasuries here. We still think they're not a bad value because the spreads on corporates and even munis aren't just there to take the risk.
Yeah, that's something that, right. The spreads are still pretty narrow, correct?
Correct.
Speaking about the big picture of the market right now, do you think we're going to bounce off of this and this is sort of the low of this most recent sell-off, or is there a move to go further down? You say things are still overvalued.
Sure. I talked to some friends of mine. A really good friend of mine is a great trader, and he's telling me at 55.30 or something on the S&P could break through. And I'm listening to a lot of great technical analysts saying that you'll get a bounce here. It's hard for me to tell because emotions can run to extremes, as we know it. I think emotions ran to extreme to bring the NASDAQ up so much for 2 years in a row, and it could take you down a little bit. I would look at this as an incredible opportunity for good companies. Find the companies you really like, find the valuations that make sense, and you average into them. Right now, we're looking selectively for tech if they get sold off more. We need a little bit more of a sell-off there.
Hey, Max, just got about 25 seconds left here. How much have you been looking overseas? The Euro Stoxx 50 is still, it's up about 10% so far in 2025. Opportunity overseas, and just quickly.
Well, we don't look much overseas because we buy such global companies and the currency risk. And sometimes I get very upset with the tax structure of how the dividends come back. So when we invest overseas, it has to be tax-friendly countries with us. And there's only a few countries that do that. So we're mainly buying domestic global countries.
All right, got it. Hey, listen, good to check in with you. Max Wasserman, he's founder and senior portfolio manager of Miramar Capital, joining us from Northbrook, Illinois.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.